Hi, everyone, and welcome back to our trading podcast. Today, I'm your host, I'm Liao, and today we have William Lau. He's a senior dealer and also a product specialist from Phillip Capital. So, how are you doing, William?
Very good. Thank you. Now, nice to see you again.
Okay, yeah, same. Thank you. Yeah, so today our podcast title is US Indexes, upward reversal or just a rebound. So we all know that the US indexes has rebounded about 15% from its rock bottom after entering a bear market territory in May 2022. So today, William, you let us know, is it just a rebound or the start of upward reversal? Okay, so without further ado, I will pass it to William. Okay.
Okay. Thank you very much, Liao. Okay. So before I start, just a quick disclaimer. So whatever that we share today is only for knowledge sharing purpose and it's not a buy or sell call. Okay. So let's move into our topic today. Whether US indexes rebound at the moment, is it just a rebound or is it a reversal? Okay. So there are a few things that I personally look at. Okay, but they are all related to the treasury yield curve. Okay, so the first one that I'm going to look at is what will happen usually in the history. What will happen when the 10 years treasury yield is actually lower than the 2 years one. Okay, and the second thing I look at is to use the yield curve to identify where is actually the bottom of the US indexes. Okay, and lastly, we will look at how do I actually capture this rebound. Okay, how do I capture this rebound? Okay, the first one, this looked a bit complicated, but let me explain. Okay, so in the past 10 to 20 or even up to 30 years, what will happen when the US 10 years treasury yield is moving lower than the 2 years? So lower means that if we talk about us as a retailer, we put money in the bank. Okay, if we put our fixed deposit in the bank for a longer term and the interest we get is lower than we just put the money for a shorter term. Like, for example, 1 year fixed deposit interest is lower than 1 month fixed deposit interest. Is there something wrong in the financial market if you put your money in the bank and the short term interest is higher than the long term? Do you think that there would be a big problem in the market? Okay, yes, the answer is definitely yes. So when the global treasury yield, right, for long term is moving lower than the short term, there is a big problem in the market. Okay, that means something is wrong in the market. That why people wants to put their money into the bank for a longer term. You know, there's something very wrong. Okay, so if you look at this chart, right, back in 2000 dot-com bubble, okay, so S&P indexes actually dropped 45%, not immediately when the whole thing invert. Okay, with this thing we call the inverted yield curve, which means the yield curve becomes a negative territory. Okay, so S&P don't drop immediately. It drops after 7 months of the inversion. Okay, S&P only dropped, as you can see, the inversion actually started here, but S&P only start dropping here, reach a peak here, and then only start dropping, which is 7 months later. Okay, this is back in 2000 dot-com bubble crisis. Now, let's move forward to the next crisis after the dot-com bubble, which is the 2008 financial crisis, which is caused by the US housing bubble. Okay, so if you look at this, right, the S&P actually drops 54% 20 months after the inversion. As you can see, the first inversion becomes this black line here is a zero. So moment it went below this line, it means that the 10 years treasury yield is actually lower than the 2 years. So as you can see here, it actually went below it somewhere here, but the correction on S&P indexes actually happened here. Okay, so the orange line is referred to the S&P 500 indexes. So as you can see, it's 20 months later, the whole thing's only collapsed. Okay, and let's look at the latest one, which is the COVID pandemic. Okay, as you can see, this is not as serious as the previous two because those are not the collection is not due to financial market, but due to a pandemic. Okay, it's a different kind of correction, which is why the yield curve doesn't react accordingly like the previous two bubble. But anyhow, you see, S&P the yield curve actually touch here, okay, touch the zero line and below, but the corrections only happen somewhere here. You see, which is 7 months away as well. You know, the correction is 20 months away. Now, if we look at this, right, the yield curve actually enter into the negative territory here 2 months ago only. You know, now we are only like 2 to 3 months after the first inversion. We call it inversion. Okay, so if you look at this one, what causes this particular inversion is due to 40 years high inflation and very aggressive interest rate hike. It's like the most aggressive ever. So do you think the correction on US indexes is done? Is it over yet? If just looking at this yield curve from the past 20 years incident. So if you understand, probably you will get your answer. But to me, definitely, I don't think the correction is done yet. Okay, I don't think the correction is done yet. Now, let's look at the second thing. So since we know the correction is not done, right? Okay, correction is not done. Now, how do we know whether the correction is finished? How do we know that? How do we identify that? So personally, I'm using the treasury yield curve to identify the bottoming. Okay, so in order for you to understand how to identify what is a bullish yield curve, what is a bearish yield curve, you need to know both. How does a bearish yield curve looks like? Then only we look at how does a bullish yield curve looks like. Okay, so this is a bearish yield curve, yeah. Okay, so back in 2019, right, before the pandemic, okay, if you understand, US actually start to tighten the monetary policy, which means tighten means increase the interest rate. So they start to increase it from 0.25% in 2016 to 2.5% in 2018. So the whole thing actually started in 2016. So 2019, this is the yield curve in 2019. Yeah? So in 2019, actually is the final result already. So which means it's at the end of the tightening. It's at the end of the tunnel already. So this is how the end of the tunnel looks like, the yield curve. Okay, so how to read this chart here is that, so okay, you look at this one, the orange line, okay, this is orange line, is the yield curve in 2019 March. Okay, if you look at March, right, so this line here is 1 month, okay, 1 month interest rate, something like that. Okay, 1 month yield, the rate is about 2.5. Okay, this is 2 months, so 2 months is also about 2.5. But if you look at 3 years, it's even lower. You see, 3 years is even lower. So go back to the theory that I shared just now. Is it making sense that if you place your money in the bank for 1 month and the interest you receive is higher than the interest you receive for 3 years, you place your money in the bank for 3 years, is higher if you put 1 year. Is this even logic? Not logic, right? So it means there is the Fed is still not going to releasing not going to ease the monetary policy. It's not going to be bullish for the market. You know, the market is going to either move into a downtrend or it's going to move in a sideways market. Okay, it's either way, sideways or downtrend. It's not going to be bullish. This is what the yield curve told us. So if you look at the entire year of 2019, right, every quarter, I'm using a quarterly. I plot it out using a quarter rate. Okay, if you look at it, this is a bearish yield curve because US indexes is not performing that well. Okay, like I said, either sideways or either downtrend. Now let's look at a bullish yield curve. Okay, so this yield curve is in 2020. Okay, this yield curve is in 2020. So what caused the short term? This is a very healthy one. Why is it healthy? Because if we put our money in the bank for 1 month, our rate is definitely going to be lower than 6 months. Our rate is going to be lower than 3 years. Our rate is going to be lower than 30 years. This is a very healthy economic kind of monetary policy. Because you put your money in the bank for short term, it's definitely going to get lower interest. This is totally healthy. So when Federal Reserve, they try to ease the monetary policy, right? Pump money into the market and stuff, the whole thing becomes healthy. You know, so which leads to a bullish market. So is the US indexes market very bull in 2020 after the pandemic, after June? Is it super bull? Yes, the answer is yes. Why? The yield curve tells you so. You know, the yield curve. the bullish yield curve tells you so. So if you look at it, right, you look at this one. In 2019, the short-term yield, short-term refer to 1 month to 2 years, okay, it's almost the same with the long-term, the 5 to 30 years. You look at it, there is not much gap. Okay, there is not much gap. So if you look at 2020, right, the short-term yield, the 1 month to 2 years, is way lower than the long-term yield, which is the 5 years to 30 years. It's way lower. This is a very healthy, very bullish for the US market. Okay, now if you look at this one, I just show you a quick chart here. So if you look at this one, okay, you see, this is first quarter, March 2020. Okay, orange line. If you look at it, you see the 1 month interest rate actually dropped to here. If you look at this one, right, we look at the last one. Okay, this is the fourth quarter of 2019. You look at the purple line, you see it's quite flat, you know. So within 3 months, right, within 3 months in between from here, after December, which is January 2020, until March 2020, these 3 months, right, the yield curve for the short term actually moved from 1.5% down to 0 point something. Okay, that is exactly what fueled the US indexes market to enter a really bullish mode. Okay, so if you look at this one, go back to this chart here. If you look at this, remember I told you US market enter into a tightening stage from 2016 to 2018. So if you look at it, basically the market is not so performing over this period. You see, it's very flat. Like I said, either flat or downtrend, flat or downtrend, or even until here to here is still quite flat. It's not that bullish yet. You know, there's not much incentive for you to really go super bull view into the market when the yield curve is not giving you that signal. So now go back to here. You see, 31st of March, the orange line. You see, this is a super nice bullish yield curve. What happened to the US indexes? This particular candlestick is March candlestick. Okay, the bullish yield curve appeared in March 2020 when Federal Reserve eased the monetary policy and lead to a very big bull run. You see, okay, so this is how exactly S&P 500 performed after the yield curve moved from bear to bull. Okay, so this is the latest one. Okay, this is the latest one. Okay, so where are we now in the treasury yield curve? Where are we now? So we understand the bull, we understand the bear. Now we try to know where are we now. Okay, if you look at it, this purple line is dated 30th of June. Okay, dated 30th of June. Is this a very bullish yield curve yet? The answer is definitely no, because this thing needs to be, we need to wait until the very short term, the 1 month interest rate rise to probably above 2.5 into a straight line like this, then only it will move back into something like this. When the recession and then the Fed will try to ease the monetary policy, then the yield curve will start to go back to this shape. So when we see this kind of yield curve, then it's time for us to really go into and long the US indexes. That is where the big bull run is going to happen. Okay, but definitely not now, because the yield curve told me not now. Okay, now since we understand definitely it's not now, okay, now how do we catch the rebound? Because we can't just sit there and wait for US indexes to go into a bullish mode again. That might take years and years and years. So does that mean we don't trade? There is no opportunity at all? The answer is no, because no matter which cycle, there are always opportunity to trade. Okay, so every time when the indexes enter into an oversold or oversell territory, there is definitely a very strong rebound. Okay, there's a very strong rebound. When I mean strong, it's like immediate a 10, 15 kind of % of rebound. That is a very good opportunity for us to trade. So this is how me myself actually catch this big rebound. Okay, so if you understand, on the 15th of June, the Fed actually announced to increase the interest rate. Okay, this green candle here is actually 15th of June. Okay, the Fed increased the interest by 0.75%. Okay, but subsequent, the next day, there are news or rumors in the market saying that it's going to increase by another 0.75% in the subsequent FOMC, which is July, which is upcoming next week. Okay, there are news or rumors last month. So immediately, Nasdaq actually dropped 4 point something % here. Nasdaq actually dropped 4.something%. But subsequent that news, right? Okay, subsequent that news, even here, after 1 month, this is 16th of June, after 1 month, there are news again in the market telling you that US Federal Reserve is going to increase it by 1%. Even that 1% doesn't make the US indexes drop anymore. And it's trying to forming this higher high, higher low kind of setup. Or not higher high, I mean higher low, at least a higher low, 3 higher lows here. So when US indexes, right, they do not react to all these negative bearish news anymore, it's likely that a rebound is going to happen anytime soon. So to me, this kind of setup is definitely opportunity to long until the 200 moving average. This is a huge resistance. Okay, I don't think it's going to go above it that easily. Even if it does, it's going to meet selling pressure very, very easily. Okay, so we try to long the indexes. We try not to do it too near to the 200 days. If it is very far away, yeah, there might be opportunity, but breakout already lah. But breakout already. So usually, the way I trade is that if the indexes break out and it breaks below again, then it's not attractive to long anymore. Okay, because buyers might just exit already. Okay, so probably you need to wait for the next setup lah in this sense. Okay, because it breaks out already. Okay, so basically, to conclude my whole thing, okay, how far will the US indexes correction? Okay, first, 10 years and 2 years, the yield curve is signaling a very deep recession is coming. Okay, US indexes is unlikely to enter a bull cycle. The second, the treasury yield curve itself is still showing a bearish curve to me. Okay, it's still under a bearish curve. So US indexes is unlikely to enter a bull cycle. Okay, and from technical perspective, US indexes is still moving below the 200 days moving average. So to me, that is not a bull market. Okay, so overall, if you ask me, it's either a sideways or a downtrend market. So don't be too aggressive on your long, and don't try to hold your long for too long, because you might give up all your profit. You might just lose all your profit. Okay, so with that, just a quick one. We are actually doing this promotion on US indexes. Okay, if you want to trade US indexes at very low margin, like 200 USD at the brokerage of 2 USD, I think this is a very good product for you to trade. So if you want to know more about this promotion and how to trade the US index CFD, you can try to talk to us and we can let you know more about it. Okay, and if you want to open an account, you can just scan this QR code, of course. Okay, and yeah, I think that is all from me.
Okay, yeah, so thank you, William, for the very informative sharing to us about the US indexes. Okay, so just like William as mentioned, if you want to trade the US CFD or if you want to open an account, feel free to contact us. You can leave your details to us and our representative will be in touch with you. Okay, so with that, I think that's the end of our podcast for today. Thank you, William. Thanks for your time.
Okay, thank you. Thank you, Lau.
Thank you. Bye-bye.